was also left. Let's also welcome on board Mr. Abneesh, Executive Director at Nuvama Institutional Equities, to understand what we can expect from the quarter going ahead. Abneesh, hi, morning. Thanks so much for your time today. And exactly like we were talking about earlier, despite positive revenue growth for most of these companies in quarter one, margin contraction is and continues to be a common theme this quarter. Help us understand what are some key structural or seasonal pressures weighing on FMCG margins across the board this time.
Yeah, good morning and thanks for having me. Yes, we have seen in most of the company results which have come in the FMCG, either the India volume growth has been ahead of expectation or it has met expectation. So clearly in Q1, we are seeing that early signs of urban slowdown now pausing, and now urban recovery gradually will start. Even for ITC cigarette business, if you see, the cigarette volume growth has accelerated. In Q1, on a 2-year basis, it's a 9% plus volume growth, while in Q4, it was around 7%. Even for HUL, which is again the behemoth of the sector, it was a 4% volume growth and versus a 2% previous quarter. We do see that in most of the categories and companies in Q2 and going forward, we will see a slight recovery, gradual recovery. Except the summer category. In the summer categories, both Varun Beverage and Imami saw YOY negative volume, especially Varun Beverage at -7. Even in Q2, although base is favorable for Varun, the high monsoon will be slightly monitorable. Coming to your specific question on EBITDA margins, my sense is in most of the companies, worst is behind. If you see HUL, they have proactively reduced their margin. So it's a more aggressive HUL, which is leading to a slightly lower margin profile. Otherwise, if you see from a outlook perspective in HUL, coffee and tea cost will correct, which should help their margins. Even in Q1, there was, I think, some of the commodities like the detergent, etc., which were in control. Now, PFAD also should correct because palm oil has corrected. That's the soap raw material. But in HUL's case, they have consciously reduced their EBITDA margin from 100 bips, which will be flowed towards growth. But for other companies like ITC, you will see improvement in margins in Q2, Q3. Q1, there was a mix of 3 issues: higher tobacco cost, which has now corrected; higher education stationery business in FMCG, where Chinese imports have impacted. But Q2, Q3, the salience of stationery education business is very low. Plus, FMCG part of the business will see palm oil benefit, cost deflation. Even in Nestle, exactly same thing. Q1 was impacted because of very high coffee costs. Post that, coffee has corrected 30%. Even for tea companies, the outlook is good from a raw material perspective. The tea crop is good. So overall, Q1 was a bottom in terms of margins for most companies except HUL, where it's a conscious strategy. But frankly speaking, I don't see much of a reason to worry on HUL. We are positive on HUL. The volume and overall sales trajectory will improve. The parent Unilever gave very strong and positive comments on HUL. Yes.
Sure. But Abneesh, what about urban recovery? Because, we have seen managements note that green shoots are visible, but does it seem like it's going to finally become a more sustained recovery, and the worst in terms of lackluster urban demand could be behind us?
Yeah, it's a good question. So if you see, urban consumption has been slow in FMCG, QSR, apparel, the other forms of durables and many forms of the consumption. My sense is in FMCG, we will see gradual green shoots emerge, and still rural will grow faster for FMCG next 3 quarters. But versus negative volumes in FMCG urban last 3-4 quarters, now we will see that gradually for most categories and most companies, urban will come back to growth. Because see, food inflation is in control, overall inflation is in control. There have been interest rate cuts. There has been the higher tax rebate by the government. All this is helping the FMCG. But in some of the other forms of consumption, still there's a challenge because there is now a fresh development of IT jobs, right? We saw TCS slash 12,000 jobs, and overall IT sector jobs are looking slightly an issue. that will impact, my sense, the discretionary form of consumption, the retail consumption. But for FMCG urban, I think the problem was in the lower end of the population, and there the softer food inflation, interest rate cuts have helped. While for the retail QSR, the issue will be more in the mid and the top end of the consumption. There could be slight issues, but for FMCG clearly we'll see green shoots emerge for paints also. So Asian Paint also we are positive.
Right, hi Abneesh, morning. This is Shrishti also joining in, but also help us with your view on the pricing power across the FMCG categories going forward. Do you believe that the companies still have any headroom to raise the prices, or is it that cycle is now behind us because given the competition and given the subdued demand, there's no much of an headroom to actually go ahead and do that?
So in fact, we are of the completely opposite view. Three important things. If you see long term, FMCG has taken a 2 to 3% annual price hike on an average. Currently, if you see, we don't need that hike because, as I said, most of the RM is correcting. Coffee is down 30%. Tea crop is looking very good. Next 1 month, we'll have more clarity. Palm oil in control, crude in control. I will say almost all the conceivable raw material used in FMCG, almost everything is in control with a good monsoon. I will say again, the agri imports, the dairy, etc., should be benign. So I don't see any reason for the 2 to 3% price hike because there is no need, right? FMCG companies take hike when there is a cost inflation, which is not there. Coming to growth, as I said, worst is behind on the urban, gradual recovery will be there. So there again, there is a good news from a macro perspective. On the competition, frankly speaking, FMCG in India has always been competitive. In fact, on the D2C competition, my sense is worst is behind because a lot of the D2C companies are focusing on profit. Because there is a huge consolidation, right? HUL acquired Minimalist, Oziva, etc. ITC has acquired many companies, Marico. So clearly, we see that most of the good D2C companies will be acquired by the listed companies, and the smaller unlisted D2C will focus more on profit. So they will not go away completely, but my sense is worst is behind on the D2C competition. All the Q-commerce and e-commerce companies also, if you see the number one, number two player in any category, they have a very strong relationship with the quick commerce. So it is not that quick commerce works with very strong, small regional brands or a long tail, because they are also now focusing on lesser, darker stores. If you see today's development, quick commerce is also focusing on consolidation in terms of dark stores, which is good news for the large FMCG companies.
The other thing, Abneesh, I wanted to ask about also was, while staples and core FMCG seem to be recovering, what is your take on big box retail after a mixed set from, say, D-Mart? What can we expect from Trent this week?
Trend, if you see, anyway, the outlook came in the AGM, etc. So to that extent, I think Q1 numbers on the sales, etc., is already discounted in the stock price. For Trent, there are two issues. One is, yes, the base has been high past few years, so some catch up is there. As I said, in the apparel, QSR, retail, still because of the IT sector, job hiring being slow, salary hikes being slow, that part of the consumption is very important for the apparel and retail companies. So that is a challenge. Third, of course, is in Q1, there was some shift, right? This time, some of the festivals, the impact was in Q4. V-Mart highlighted that, some of the other companies are highlighting. Coming to Avenue Supermart, clearly UP entry is a big positive news. So I do expect that the store addition for V-Mart versus 40-50 stores last few years, I think that will get a good leg up next 3 years, 5 years because of the Uttar Pradesh entry. We see that the V-Mart store addition should pick up. Neville, the current CEO, he did highlight that that is the most important focus for D-Mart. So D-Mart, again, competition for quick commerce is still there. But from a store addition perspective, it will clearly pick up, which is a positive for D-Mart. Uttar Pradesh is India's largest state, and entry there into Agra, that really gives a good lead indicator that next 3 years, 5 years, the overall store addition will pick up.
Abneesh, before we let you go, help us understand your pecking order in the entire FMCG and consumption space. Which stocks are you liking for, let's say, the next 6 to 12 months?
So we'll be more positive on the FMCG and paints. In FMCG, we like Britannia. The results will come this week, so we'll have more clarity. But from a 6 months, 12 months, we continue to like Britannia. We see a strong year for Britannia, both volume growth, sales growth, and margins in FY26. We like Hindustan Unilever. We have seen the strong comments by the company and the parent for the India part of the business. We also like Nestle. Coffee cost has corrected 30%, and from next quarter we will see recovery. We like Asian Paint. Clearly, there the competition has now stabilized, and now we are seeing slight pickup in the urban part of the recovery. We like BKG. So overall, FMCG, I think sector should do well. We are seeing investor rotation also from some of the sectors where there are headwinds like IT sector towards FMCG, because FMCG clearly demand and margins both are looking favorable in FY26.
All right, Abneesh, so good having you on the channel today. Thank you so much, as always, for your time and speaking with us. But with this, viewers, time now to slip into a very short break. Don't go anywhere. We'll be right back with more on the other side.